Hello and a warm welcome to the Open Treasury Podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most.
Welcome to the Open Treasury Podcast. This is Craig Jeffery. I'm sitting in for Pushpendra Mehta, who is off for March 3rd. In the hot seat today are Jack Large, who's the editor of CTMfile, and Paul Galloway, who's a senior advisor at Strategic Treasure. Welcome back to the Open Treasury Podcast, Jack and Paul.
Good to be here.
Yep. Thanks, Craig.
So this week, we're discussing 6 stories that run just across a few number of themes, 5 themes, in fact. We have 2 bonus stories if we get time to get to them, but I know we won't. There's just too much content to cover. For those who are listening, you can see the articles in the show notes. You can find the links to those articles as well as some different stories. And you can go to CTMfile.com for more information. A couple articles on the cost of quantitative easing on the economic side. Jack, I'm going to start with you. 2 articles. One brought up the fact that Eurozone central banks are outlining the cost of quantitative easing, this idea of activities and changes in interest rates that they have to pay is creating a challenge. A second article talks about the European Central Bank reports a loss as a result of its own rate increases, and it has gone forward and eliminated dividends. This seems like a natural occurrence for the activities that they took. How are you thinking about this?
It doesn't come as any surprise. The statement from the Portugal governor saying, because of the mismatch of interest rates and assets and liabilities, we're going to have problems. Well, that's by definition what's happening in quantitative easing. They're having to take some risks. And we're seeing the same sort of thing from the European Central Bank, where they're struggling with the different types of operation they're having to perform. I don't find it surprising. What I do find surprising is people are saying this is new and different. It's not. In the 1970s we went through it. We're just going through the same sort of thing again.
So is this Paul, I'll invite you to join in too. Jack, is this just a situation of, as a central bank, we take on a lot of assets. Now rates have gone up. We have to pay more. And that's just part of the exposure you face, or is there anything else that we need to think about there?
Well, the other major impact is the inflationary pressures, which is one of the things that's driving the quantitative easing programs and the adjustment programs like in the Bank of England. That's not going to go away. This stresses on the central banks and inflationary pressures are global, and it's going to continue, I think, for at least another year or more. And the consequence for corporate treasurers is they have to be very careful and assume that interest rates will go up. I noticed New Zealand Central Bank said their interest rate's going to go up, they think, to 5.5. Well, that's way away from where we were at the beginning of 2022. This is big change stuff.
Yeah, Paul, with the elimination of the dividends by the ECB, is there any additional repercussions that you expect from this that corporate treasurers need to be thinking about?
Several things. There are definitely issues for corporate treasurers with rising rates. Inflation continues to be there. Central banks across the globe, they're facing similar issues. And anytime you see the elimination of a dividend, that's certainly cause for concern. I think what would be the telling sign in this kind of environment is, how long does this pause kind of last? Is it something that's going to be extended, or is this just something that is transient in nature and short-lived? I guess time's going to tell. But when I think about where inflation continues to be, it appears to be in many locations oscillating within a certain range, while central banks continue to raise rates. And what's interesting is that what I've been talking about for several months now on prior podcasts is 2023 is going to be painful. And we thought there was potentially some signs that it wouldn't be as bad as what it could be. However, that's swiftly changed recently with reports that inflation is turning out to not go away at the pace we were hoping, which means central banks are going to have to make bigger decisions, meaning rates are going to have to be raised at a higher level than what they wanted. I've heard within the U.S. potentially that a 6% handle is not impossible this year. Now that would be significant. New Zealand at 5.5, that's a big number. Europe's probably facing a similar situation. And, it's the pain that we have to endure to get to a better place in the long term. You can look at, I don't know where the yield curve is exactly at in Europe, but I know in the US it's pretty severely inverted now, and has worsened. And that's a sign of recession, at least it has. It's predicted the last 7 recessions in the US. I think this year is just going to be a tough year.
Yeah. So as we move off of central bank debt and challenges there, let's move over to debt default, sovereign debt default. Ghana verges on debt default is a recent article. They're into the grace period on a $40.6 million coupon, part of their $46 billion local and international debt. Kevin Daly, who's an investment director at ABRDN, indicated that they are in default. Ghana is a fairly small economy by global standards. Depending on how you measure it, it's anywhere from 70-something to 100th position from a GDP perspective. Is there likely any type of contagion or impact? Let's just focus on Africa, right? But given their size, I doubt anybody would say this would be the cause of global contagion. But will this cause, a default here cause a pullback in investments into Ghana and other African nations? I'll start with you, Paul, and then jump over to Jack.
Sovereign debt default is not a good thing, right? No matter where you're at. And do I think that there could be a pullback on investment in areas where default has occurred or the potential of default is there? I think there absolutely is. I think people will get skittish. And let's face it, in the global economy today and where things are at, people are starting to get a little nervous when they see things like this. And if it happens to be, you could argue, are they in default or not default? There might be some that argue, yeah, they're in technical default. They're reorganizing. So, they're going to deal with the default and they're going to try to make good. Well, that may or may not happen. We don't know yet, right? It remains to be seen. But this gets people nervous when they see headlines like this and a sovereign nation is saying, hey, we got to restructure and they're in technical default. It's cause for pause. And will that filter through the rest of Africa? It potentially could hit other areas.
Jack, are you more gloomy or more rosy than...
No, I'm afraid I'm more gloomy because I think this is an indicator of the stresses inside Africa at the moment. Not only have we got the war and earthquake in Syria, but if you look around other countries like Nigeria and so on, they all have severe problems and countries haven't got a long record of stability, country stability. I think that what the net thing is going to be that there's going to be less investment in Africa over the next 12 months as companies cautiously work out what they can and cannot do. I mean, we've already had Zambia, Mozambique and Ivory Coast defaulting earlier. We could well see other countries going as well. I'm sad to say if I was an investor or a treasurer with funds in Africa, I would be very cautious.
Yeah, no doubt, Jack. I mean, it's definitely concerning, without a doubt. And, you think outside Africa, and, there's definitely potential issues outside that country as a whole. I think investors are going to get more and more nervous about things as the global economy continues to progress with these rate hikes and trying to deal with inflation and the other geopolitical things that are going on. There's a lot happening.
Well, continuing our discussion there on interest rates and now onto default and then onto rate hikes. Jack, Goldman Sachs put out some information that they expect 3 more rate hikes from the ECB this year. Earlier in February, they did a 50 basis point increase, brought up their rate to 2.5%. They expect Goldman expects it to hit 3.5% this year. This is higher than an estimate they had before of 3.25%. What's going on here? Is this just reflecting the reality that the central bank in Europe is going to have to increase rates to tamp down inflation, or something else occurring?
It's partly that, striving to beat inflation, but already we're seeing some economic analysts saying that raising interest rates isn't the way to beat inflation. But the other problem is, and Paul raised it earlier, is the turmoil we've got with geopolitical events such as climate change and war in Ukraine and so on. It's just adding to the turmoil. And what a central bank does is it says, well, we need to dampen things. So they put interest rates up. And Christine Lagarde at the ECB, she's a typical banker, and not for very long, by the way. Their immediate reaction is to put interest rates up. And I feel that we're going to see more hikes, not just in the ECB, but across Europe. The Bank of England is already considering further interest rate hikes. It's not a good time to be a user of loans and borrowing.
Yeah, Jack, I mean, this is a global theme. Rates are going to continue to rise. We're seeing it all over the globe. It's problematic of the global economic environment we're in. There's lots of things happening driving that, and I don't see it slowing down anytime soon. I think, throughout the remainder of the year, there's going to be additional pain coming our way. Hopefully, some savvy treasurers out there have positioned themselves before the end of 2022, trying to take advantage of access to capital, but being able to put capital or access to capital on the balance sheet in terms of contingent capital facilities, revolvers, other things in place to shore up a balance sheet so that they have enough access or availability of capital in their pockets. Because if they have to go out and do it this year, it's going to be expensive.
Yeah. So as we move off of rates and that type of activity, we're going to shift to a different story about crypto and the battle between fiat and crypto. The BIS chief, Augustin Carstens, said that the battle has been won. Technology doesn't make for trusted money. And so this is doesn't say the whole war, but certainly he indicates that the battle has been won, that fiat currency has been won, and goes on to bring up a number of significant points about the legacy infrastructure of central banks offering a better posture and position. He also makes some proposals about central bank digital currency. Is this declaring a victory too early? I mean, we've seen Bitcoin drop down into the 16,000 range, end of 2022 through most of January, and into February it moved back up north of $20,000 versus its peak just back in 2021, just under 70,000. Is this too early to celebrate the victory, or?
I mean, I feel like it's too early to celebrate the victory. Crypto is still relatively new compared to fiat currency, certainly very much new. Time is going to tell us, and I don't think there's been enough time to say that crypto's dead, it's gone. Do I think central banks in the introduction of a digital currency is going to happen? I do. I think that's going to happen. I don't think fiat currency goes away. I think there's going to be a need for that at some level. There's just some people that will probably never trust a digital currency. They like the paper. They like to have something in hand. So from a crypto standpoint, there's still infrastructure to be built out. Regulation is probably something that is front of mind from a lawmaker perspective, and also central banks being able to strengthen regulation around cryptocurrency, I think will help it survive longer term. I just don't see that it's dead yet. And there's still quite a big demand out there for crypto, even if it's taken a pretty big hit with the downfall of FTX. So
yeah, FTX was one of a number of events in line, which has impacted that market. Jack, any thoughts there? And does this change anything that we're thinking about for corporate treasuries who may want to receive crypto as a way of supporting their customers, but maybe not investing in crypto?
The thing about crypto is that it isn't just an investment. It is also proposed as a currency for moving monies around. I think you have to split them. Oh, by the way, I love how, for the first time ever, a central banker has come out and encapsulated the problem. They do see crypto as a challenge to the fiat currencies, and they are trying to split the decision between investment and transactions and between central bank supported tokens and crypto supported tokens. And they're very different, and we are going to see more and more of that. But I don't think crypto is going to go away. But on the other hand, neither do I think the fiat currencies are going to go away, because we're always going to have to move monies. Treasurers already starting to invest a little bit in cryptocurrency just to find out about it. They are definitely spending time, quite valid time, on how to use the digital tokens that are coming from the central banks, because those will come in large numbers and may well dominate some currencies locally. I would, again, with crypto, like many other things, I would be very cautious if I was a corporate treasurer. This is not a easy to handle problem or solution.
No, I think it seems like most companies that receive payment in crypto quickly convert it to a fiat currency, which makes sense based on what both of you said. Now, our last story to comment on is a little bit more interesting. We're talking about AI restrictions. The article about JPMorgan restricts traders' usage of ChatGPT due to regulatory risks over financial data. This was stated that it was the limitations placed on ChatGPT are part of standard limits on third-party software and not related to any specific incident. They further surveyed some of their traders. They found that just over half of them predicted AI, or artificial intelligence, will be the technology with the most significant impact on trading in the future, more than twice as high as last year's finding. So with the release of ChatGPT, and probably all of us have played with it for some time, it seems like that is really ramping up the expectations of AI, making significant changes in trading. Jack, what are your thoughts here on AI? No holds barred on this one.
The AI is definitely coming. There's no doubt about that. It's used in all sorts of different ways in different places. Quite a few of the times we don't know it's going on. But ChatGPT is, I can see why JPMorgan stopped using that in chats between traders, because the deductions that AI can make from inconsequential chats and bring all the different pieces together could be quite significant. So I understand that. But AI is definitely coming in trading. AI is coming in many different ways. The worry I would have is if I'm talking now as a treasurer, if my trader started using ChatGPT to his or her daily interactions or part of their daily working life, I would worry about that. In fact, if I was a treasurer, I would ban it. I wouldn't allow it.
Yeah, certainly when you look at how people have made use of search engine activity to indicate selling or buying activity related to different companies, you could see how the use of this AI for chat, asking all kinds of questions, may provide this other feedback loop, which they didn't want to see. Paul, concerns, opportunities here?
I don't believe JPMorgan is the only bank anymore that's starting to restrict chat GPT. I think other banks are starting to follow suit along the lines here. It's just interesting. This particular open source code blew up really quickly. And I think where my concerns are, is it blew up without knowing enough about the capabilities of this programming, what it can do. Yeah, and it didn't take them long to start figuring out, there's some aspects to this that aren't good for an organization, and we need to make sure that we control it better and manage those risks. And certainly from a trading aspect, I can see why you don't want to disclose financial information. You don't want things where hackers can get access to data or information that's sensitive. It doesn't mean that AI doesn't have its place. I think it does. More and more organizations, treasurers, are looking towards AI as a tool to help them with decision making. Some of the things that they do, activities that they engage in to improve them and make them better. My hope is that this experience here with some of the risk issues, concerns that have been brought to the forefront with ChatGPT, give folks an opportunity to step back and make sure they understand what they're going to engage in before they engage in it, so that they ensure that it's going to control the integrity of their operations and not expose the organization or the customers of the organization to a loss of data.
Back in World War II, there was this phrase that went around. It's like loose lips sink ships. And this idea that if, the ability to listen in on all these conversations, not that there's a hack of a computer per se, but if people are typing in all kinds of questions, there's an ability to triangulate that, just like a bunch of information could cause an enemy to locate a particular ship, its location or its path that it's taking. That could create an issue. I think this may be what they're concerned about there. But let's move to the recap. We'll start with you, Jack, and then Paul, you'll go next. What's the biggest or most important story or theme of the past week or month? You got free reign to cover what we've talked about today or some other issues as we look at the past month, and maybe you just give an explanation for your reasoning. Go ahead, Jack.
For me, the biggest thing is, and it's been consistent over the last 2 or 3 weeks, is that the world is in turmoil. Turmoil from inflationary pressures, turmoil from geopolitical events like the Ukraine war, like continual investment by banks in fossil fuel investment, which is causing all sorts of tensions. And out of that becomes a big problem as to how a treasurer can steer a steady, sensible, profitable course. And this is where we're starting to see the pressure on treasurers to really understand far more than they used to the dynamics of the business and the implications of the technologies and the supply chain risks. It's managing all these risks together is what's having to be done by corporate treasurers at a level that I've never seen before.
So a macro view of turmoil and managing multiple risks is the big theme. And I guess I would say that's your view of the last month, at least, based on what you just said. Paul, how about you?
Jack really kind of hit all the main points. Obviously, I believe central bank rates are going to continue to be raised. Inflation has not gone away. There's lots of geopolitical risks out there. Last week, when Russia decided to walk away from the nuclear treaty that was in place between the U.S. and Russia, I see that as a bad sign. There doesn't seem to be any wavering from their war in Ukraine. I don't believe that China's proposal is a earnest proposal for resolution there. It just feels like there's more extended conflict in the future in that area. I've heard that there's a report out there that Belarus may be annexed as part of Russia. So it kind of feels like Russia continues to move forward with Putin's plan, whatever the long-range plan is. It doesn't feel like it's good. I just have really big concerns about what's going on over there. It feels like there's potential for a lot more pain ahead, and it could trickle into a more global crisis as it continues to go on.
So more concern on a global level. You two have certainly been very, very cheery but realistic today with what's going on. Thanks everybody for listening in on this discussion on the Open Treasury Podcast. Visit CTMfile.com for more items on these articles. Thank you, Jack and Paul.
This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit CTMfile.com.